right, during this episode, we're going to talk about an event that has occurred only 6 times within the last 100 years. However, has had huge impacts in the past. So it's very, very important to monitor. We're going to dive in. So stick with me. My name is Brian Cannon, and welcome to Markets in 5. All right, starting off with the S&P 500, like always, we've got this up-channel trend we've been talking about, out of the downtrend from 2022, and the importance of really kind of making sure that we have higher highs and higher lows. And technically, we did break down. We broke down below the channel trend. You can kind of see it came down, hit the 200, popped back into our zone. But couldn't get through this downward trend that was happening here on a shorter term basis. You can see kind of lower highs, lower lows. So it did break all the way down, and we did raise cash. We've got, and I say cash, more like short-term treasuries that are paying around 5%. So we've got a fair amount of positions in short-term treasuries right now, just because we're below the 200-day and because we've broken down on this channel. So again, if we can break back above the 200 and get back up maybe above this downward sloping trend line right now, we would feel a lot better. But as it stands right now, MACD is still in below the 50 zone, which is generally not good. And you can see the MACD is about to cross over, but again, a crossover to the upside is constructive. You just have to be a little bit careful with it when it's below the zero line, right? It can serve as an early indicator. However, it can also whipsaw you in and out of trades. So it's better to cross over and then also break back into the positive zone. So we're watching that closely. So only 6 times in the last 100 years have we experienced inflation, and so there's not a lot of data points to pull from. And if you kind of think about where the world has gone from horse and buggy to space travel, it's tough to draw a lot of correlation. But there are certainly some things that you can kind of connect. But essentially, no one knows what's going to happen. We get a lot of questions. Hey, Brian, what's the market going to do? Or what do you think about inflation? And the reality is nobody knows. None of the talking heads on television. I don't know. So what we do is we try to pull some clues from history. And so what history suggests is that during periods of inflation, we've had, they've all fallen within secular bear periods, where essentially the market has done nothing for a long period of time. It's kind of had a sideways motion where it really hasn't broken out and made new highs. And those periods have lasted, 24 years, 13 years, 14 years. And so we're so far in, we're 10 years into a secular bull market, and we have persistent inflation that the Fed just can't seem to take care of. There's too much money in the system. And so the last time, out of the 6 times, including now, the only period that has lasted this long occurred back when we had a major secular bear market in the 70s and 80s, where the market really experienced stagflation or slowing growth along with inflation. And just persistent inflation that wouldn't go away. So that was a very, very slow time for the market. And I feel like, if they can't get inflation tackled soon, I don't see how we would avoid a secular bear market. And so, if that happens, trend following is going to come back into favor. You're going to want to make sure that you're following various parts of the market and avoiding other parts of the market. So there's a lot to do if we get into a secular bear market. So I don't know if we're there yet or not, but I can just say, historically speaking, we haven't had a secular bear market without inflation, and we haven't had inflation without a secular bear market. So if you draw those conclusions, I would say history suggests that we're in for a period of slow growth and persistent inflation. All right, so the last chart I'll leave you with is the unemployment rate, and I think this could be the clue that really ties it all in together. I'm going to do a little bit deeper dive on this next episode. So, I won't spoil it, but but the idea is this is going to be extremely important to watch. I'm trying to get out of the way here. This unemployment rate is going to be very, very important to watch. If unemployment goes up, and it's combined with inflation and all the other factors, it's a recipe for recession. So again, I'll do a little bit deeper dive on that next episode. As you can see, we're in kind of unprecedented times. So we've got a lot going on, and inflation is a very important factor we need to keep our eye on as we move forward. So, but if you have any questions, give me a shout, and I'll see you on the next Markets in 5.